Welcome to Mountain Real Estate. I'm Candace Day, and today we're digging into mortgage interest rates. So, we're going to talk about a few things. One is how they're set, um, two, what actually moves them, including the Federal Reserve rate, which has been a hot topic of discussion this September, and then what the current rate environment looks like here in Summit County and in Colorado in general. So, if you're thinking about buying or refinancing or just curious how they go up and down and how that affects your purchase, hopefully this episode will give you some clarity. So, let's start with the basics. Mortgage rates aren't chosen randomly. So, lenders need to cover the cost of their funds or the cost or what it costs them to borrow money. So they look at benchmarks like the 10-year US Treasury bond yield because investors look at mortgages and treasuries as competing investments. So they're both kind of long-term investments versus short-term investments. So investors like things like pension funds or insurance or hedge fund companies can put their money into different types of investments. So they can put their money into treasuries, they can put their money into corporate bonds, they can put their money into stocks, or they can put their money into mortgage-backed securities. And really, the treasuries are considered very safe. And that is where investors prefer to invest when they're looking for safety. So if a 10-year treasury is yielding, let's say, 4.5%, investors will only buy mortgages if they can earn more than the 10-year treasury. So that extra return is called the spread. So for example, if treasuries are at 4.5%, investors might say, I need 1.5 or 2% more to take on mortgage risk because there's more risk in more mortgages versus the safe treasuries. So that pushes the 30-year mortgage rates up to around like 6 or 6.5%. If treasuries rise, then mortgage rates usually rise. So think of it like shopping. If apples are $1 a pound and pears are $1.50 a pound, you only buy pears if you think they're worth the extra. Personally, I like pears. But mortgages have to be priced attractively compared to treasuries, or investors won't buy them. Similar to the pears. You got to like them. That's why mortgages are linked to the treasury, but they're not directly tied to the Fed fund rate. The Fed influences the whole environment by looking at inflation growth expectations, but the mortgage rate is more tied to what's happening in the bond market and how investors value that risk. So it's more tied to that long-term valuation. So let's look at what factors influence the rates. So we've got the treasury, 10-year treasury, and then we've got that spread or what that risk is. And so what impacts those and what other factors play into it? So inflation expectations, which we've heard a lot about, but when we hear that there's going to be higher inflation, investors want higher yields. So they don't want to just meet, they have to cover their future investments as well with inflation. Another thing, economic growth and jobs data. So that usually ties into the Fed rate, but it also is an indication of the overall economy. So while that's tied to the Fed rate, which is not directly tied to mortgages, it does paint a picture of the overall economy, which does sway these future projections for that long-term treasury yield. And then we have supply and demand. So the demand for mortgage-backed securities matters. So when demand is strong, rates fall. When demand is weak, rates rise. But really what dictates that demand is how many people are looking for investments. How many investors are out there looking for some place to put their money. And then we have the borrower factors. And this is really the personal side of mortgage rates. So you as the borrower, your credit score, your down payment, your debt to income ratio, whether it's a primary home or a secondary home, those all influence your mortgage rate as well. And then the loan structure that you choose, whether it's a 15-year versus a 30-year or a fixed versus adjustable, the conforming versus jumbo loans, those all matter to your rates as well. So there's a lot of factors, which is why We all want like, just let me Google my number, but the number doesn't actually come unless you put all of these pieces together. And some are external factors and some are the borrower factors. And then we've got local factors. So your mortgage, your principal and interest is dictated by your mortgage rate. But then there are other things like risk within the property that affect insurance and property taxes, which affect your overall payments, but not necessarily your rate. And all of those factors layer on top of the 10-year Treasury yield and the spread that we just talked about. So let's put some real numbers into this. And we're going to go back in time just to compare. So let's say you're buying a $1 million home in Summit County, just for easy number. You put 20% down, so you're getting an $800,000 loan on a 30-year fixed loan. So in 2020, let's say you locked in a rate around 3%, which was pretty common back then. Your monthly principal and interest payment would be around $3,373. So let's call it $3,400. Today, that same loan at 6%, which is a pretty good rate right now, jumps to about $4,800. So you go up about $1,500 just in interest, going from 3% to 6% each month. At 6.25, it goes up to $4,925. At 6.5, it climbs to $5,056. So to go from 3% in 2020 to 6.5% now, you're going up about $1,700 per month, which is about $20,000 per year on the same exact property. So that shows our purchasing power declines as interest rates increase. Another way to look at purchasing power is to say, okay, let's say we were good with that $3,373 a month. And also, by the way, this does not account for HOAs, which about 2/3 of our properties in Summit County have HOAs. So let's say you're comfortable with $3,373. Well, before you could buy $1 million house. Now you're going to be at around a $660,000 house. So your loan amount is about $530,000. So instead of buying $1 million house, you're now buying a $660,000 house to keep your monthly payment the same. So the rates obviously have a big influence on affordability. And so we're seeing that as the rates continue to remain a little bit elevated from what we saw during peak COVID levels. And we're seeing that affordability become a challenge. All right, so we've talked about what dictates the rates, and we've looked at some numbers and examples. So in Summit County right now, our 30-year fixed mortgages are averaging around 6.1%. 15-year fixed loans are around 5.3%. I had a client get an adjustable rate mortgage around 5.2%. So there's the good news is these are down a little bit from what we've seen over the last year or a couple years, but they still vary. And one of the things I've noticed is even before the Fed meeting, so again, mortgage rates are not tied to the Fed meeting, they're tied to expectations. So way before the Fed meeting, when people thought the economy was looking a little bit worse and the Fed meeting would indicate a decrease in the Fed rate, we saw mortgage rates come down because that 10-year Treasury came down. So it's not necessarily tied to that Fed rate, but all of these economic factors play into the rates. So personally, we have an adjustable rate and we are in the process of working on a refinance. So we're looking to refinance because we feel like these rates are pretty good right now and we'd like to just lock in a fixed rate at this point rather than an adjustable rate. But our adjustable rate allowed us to have a lower monthly payment for the last couple years while rates were still elevated. So that refinance cost is worth it to us because we have been paying less monthly. All right, so to wrap it all up, let's summarize kind of what we talked about today. Mortgage rates are set by a mix of investor demand, long-term Treasury yield, and risk spreads. And the Fed is one component of that, but not the dictator of mortgage rates. They're also influenced by inflation, growth, credit factors, and your personal situation. In real terms, we moved from 3% to 6.5%, and that adds over $20,000 a year to people's monthly payments or cuts your buying power by over $300,000. And that's why we're seeing the demand side be impacted. So all of this to say, this is kind of a high level overview of mortgage rates. I am not a lender. I am not an economist, but we do deal with this a lot, and we have great lenders on our team that we can coordinate with to help you find the right situation or the right rate for your situation. But hopefully this is helpful in understanding where these rates are set, how these rates are set, and what they look like. Thanks for joining.